Okay, let's dive right into this explainer and demystify the hidden mechanics of how our modern banking system actually operates. If you really stop and think about it, what does a bank actually do with your money? Most of us grew up with this, well, kind of cartoonish idea of how the whole thing works. But honestly, the reality is way more complex, incredibly fascinating, and absolutely crucial if we want to understand how the global economy actually stays afloat.
So we're going to kick things off by completely busting that old storage box myth of banking, and we're asking a pretty provocative question. Can banks really just type unlimited money into existence? See, people usually picture banks as these giant, secure money warehouses. You deposit your cash, they lock it up in a massive metal vault, and then when someone comes in for a loan, the bank just slices off a piece of your deposit and hands it over. Sounds totally logical, right? Well, scratch that, because that old story, it is simply not an accurate picture of how banking actually works today.
In fact, here's a truly wild fact for you. In many modern economies, like the United States, the traditional percentage-based reserve requirement for deposits is exactly 0%. Zero! Back in the day, you'd hear a lot about fractional reserve banking, right? The idea that a bank was legally bound to hold a certain percentage, maybe 10%, of its total deposits in reserve before lending a single dime out. But today, in a lot of major financial systems, that fixed percentage rule is totally gone. And honestly, this 0% reality is exactly why you'll hear people claim that banks can just magic money out of thin air.
So here's our roadmap for this explainer. First, the money creation myth. Second, the power of reserves. Third, the central bank's tools. And finally, steering the economy.
All right, let's jump straight into Section 1, the money creation myth, and moving past that whole storage box idea.
Okay, so here is the actual reality of the situation. Let's say a bank, we'll call them Wee Bank, lends $1,000 to a customer named Bob. They don't march down to a vault and hand him a stack of stored physical bills. Nope, they literally just type $1,000 into Bob's account. Boom, just like that, new deposit money is created. Bob gets his loan, and the bank now shows an extra $1,000 in total deposits on its books. There's no printing press running in the back room. It sounds almost ridiculous when you say it out loud, doesn't it? But this credit system is the absolute bedrock of modern economic growth. It's what allows businesses to scale up and folks to buy homes without having to stuff physical cash under a mattress for 40 years first.
But wait, if banks don't have that strict percentage requirement holding them back, what actually stops them? I mean, why can't they just type infinite numbers into everyone's accounts? That brings us to Section 2, the power of reserves, and why banks can't create unlimited money.
To understand the limits, we absolutely have to talk about reserves. Think about it. When Bob takes that brand new $1,000 loan and transfers it to pay his landlord who uses a completely different bank, Wee Bank can't just send over a typed-up deposit. The other bank won't accept that. Instead, they have to send central bank reserves. Now, these reserves are a very specific type of digital money used exclusively between banks and the central bank. They never, ever leave the banking system. You and I, we can't hold them in our wallets. They are quite literally the essential plumbing of the financial world. And if a bank doesn't have enough of these reserves to settle the payments its customers are making, well, the entire system just grinds to a halt. And that right there is the real limit on banking: capital and liquidity. If a bank gets reckless, lends out way too much, and then its customers transfer all that money away, the bank completely drains its reserves. The plumbing freezes solid. The bank faces what we call illiquidity, meaning it simply cannot move money around to settle its daily payments. And if customers catch wind of this, if they get spooked and all try to withdraw their funds at the exact same time, it triggers a terrifying chain reaction. The bank can't meet the demand. Sheer panic ensues. Bank runs happen. And you can end up with a total economic crash, much like the Great Depression. This is exactly why those reserves are absolutely vital for bank stability. Without them, the fundamental trust that holds our entire economy together just evaporates.
So to prevent that kind of nightmare scenario, where do commercial banks actually get these vital reserves? Moving on to Section 3, the central bank's tools, and injecting reserves to keep the pipes flowing.
So, a central bank, take the Bank of England for example, has this incredible superpower. It can essentially create reserves out of nothing. If a commercial bank like RBS is running low and needs reserves, they can take safe assets that they already own, like government bonds, which are often called gilts, and sell them to the central bank. The central bank takes that 10,000 pounds in gilts, and in return, they just expand their balance sheet and credit RBS with $10,000 in brand new central bank reserves. For the commercial bank, their overall balance sheet hasn't really grown. They just swapped an illiquid bond for highly liquid reserves. It's a simple swap, but it ensures they have the exact fuel they need to keep processing your everyday transactions without a hitch.
Now let's peel back the final layer of the onion here.
with Section 4, steering the economy, repos, and the interest rate corridor.
While outright buying bonds is definitely one way to create reserves, the standard everyday method used by central banks is something called a sale and repurchase agreement, or a repo. Honestly, you can just think of it as a collateralized loan. It's a simple three-step dance. The commercial bank temporarily sells an interest in an asset to the central bank to get reserves today, but they promise to buy that asset back at a specific, slightly higher price on a specific date in the future.
Let's put some real numbers to this to make it concrete. If a bank sells an interest in a £10,000 asset with a 10% repo rate, they are on the hook to eventually buy it back for £11,000. That extra £1,000? That's essentially the interest cost of borrowing those reserves. But here is the absolute genius part of the whole system. The central bank smartly pays interest on those reserves while the commercial bank is holding on to them. Why? Well, think about it. If banks had to pay to borrow reserves but earned absolutely nothing for keeping them safe, they'd be penalized just for making sure the system doesn't collapse. They'd try to hold as few reserves as humanly possible, which, as we just discussed, leads straight back to frozen plumbing, illiquidity, and market crashes. So by paying interest on those held reserves, the central bank basically incentivizes the banks to hold enough cash to keep the financial plumbing fully stable.
And this brilliant little mechanic brings us to exactly how central banks manage to steer the entire economy. By paying that interest on reserves, the central bank builds what's known as an interest rate corridor. Picture a room with a floor and a ceiling. The central bank sets a floor. Let's say they pay a 4% interest rate to banks just for holding reserves. Then they set a ceiling. Say they charge a steep 6% for emergency loans if a commercial bank completely runs out of reserves. Because of these two hard boundaries, if a commercial bank happens to have some extra reserves and wants to lend them to another bank, the rate is naturally going to settle right smack in the middle, right around 5%. Think about it. No bank is going to lend their money for less than the 4% they could get completely risk-free from the central bank. And no bank is going to borrow from a competitor for more than the 6% emergency rate.
And here is the real endgame. By manipulating that floor and that ceiling, the central bank dictates the exact cost of money in the interbank market. When banks are forced to pay more to borrow from each other, what do? They pass those costs directly onto businesses, onto your mortgage rates, and onto everyday consumers like you and me. That is the hidden mechanism. It is not just some magical dial they turn on a machine. It's a carefully managed, highly complex ecosystem of repos, reserves, and rate corridors that ultimately speeds up or slows down the entire modern economy.
So as we wrap up this explainer, I want to leave you with a bit of a provocative thought. Today, we've seen that banks absolutely do not store your cash in a metal box. They literally type money into existence. We've seen that central bank reserves are the essential digital plumbing keeping the entire system from freezing over. And we've seen exactly how central banks manipulate those reserves to steer global borrowing costs. But if central banks can simply expand their balance sheets to inject limitless digital reserves into the system whenever they want, what is the ultimate limit on their power? Can they truly prevent every single financial panic from ever happening again? Or are we ultimately relying on a fragile psychological trust that no mathematical corridor could ever fully control? It's something to think about. Thanks for exploring the hidden mechanics of our financial world with me today.